Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending April 11th, 2025. And I'm host of InvestTalk, Justin Klein. And today's video is going to be titled Foreign Investors Flee Dollar Assets as Tariff Chaos Drives Us Toward a Recession. Once again, a long title. However, this is a challenging time to sum up in just a handful of words. It takes a larger sentence to really grasp what is happening in today's market. Now, I always like to start right off with the heat map here, and what you can see is markets did bounce nicely this week, mainly driven by those Mag 7, which were down the most. You had healthcare sell off, consumer non durables, and part of this is the fact that these are these are bond proxies. So you see utilities in the red. Energy was obviously suffering, and finance was a bit mixed. You did have some strength. J.P. Morgan did have earnings, and that was accepted positively at least. But still, kind of definitely a mixed bag overall. And I'll dig into the charts in a minute, and we kind of see what things look like broadly. Now, let's talk about the Fed. Obviously, these tariff chaos is causing a lot of angst. And what's interesting to me is that there's there's definitely more. The market is leaning towards more Fed rate cuts, but it's not just one way. Okay, because if there is inflation, if the Fed has to step in other ways. Think of supporting the Treasury market. That's going to be more with QE, ending QT, which is probably going to be accelerated in this next meeting coming up early. Excuse me, early next month. Excuse me. And so, it's going to be interesting to see if we do get how many rate cuts we get. Is it going to be aggressive? Uh, and they don't seem like they're ready to step in and save the president from this calamity that he has created. He could step back. We had over the just earlier today. It looks like there will be smartphones, chips, and computers that are exempt from the China tariff, which makes a lot of sense. But at the same time, um, this is that's part of what we import from China, not everything. All right, it's something substantial. We'll likely get a bounce on Monday in markets, but once again, how much is the Fed going to step in is the real question, and I think it'll actually be less than this because of the worries of inflation. Now, eventually they'll have to step in with QE in earnest, but rate cuts might not be the way to go. Actually, I could see them actually raising rates while at the same time doing QE. Okay. Because if the dollar continues to weaken, it's not going to help to see rate cuts. We're kind of in an emerging market scenario here where typically when there's economic weakness and they want to prevent depreciation of the currency, they raise rates. Now, if you're thinking of the Trump playbook and what they're trying their ends, which is more manufacturing domestically, they actually want a weaker dollar. But how much is that going to feed inflation? What does that mean for the Fed policy? So this is a new paradigm, a new era that we are in that uh, you have to step back and think of it differently than what we've seen in the past. The fact that the dollar is going down when we're in a risk off environment is different. You need to recognize that. And I'll show you those charts here. Now, why I say we're likely headed to recession, you can see the credit spreads are widening out. We are now in an uptrend, at least, right? We have now a higher high from last summer's yen carry trade unwind. And this likely will come in a little bit. We'll go to the 1 year chart here on Monday and next week. But do we break below 3, right? Because that was this little pullback here in late March before Liberation Day, and then you had that breakout. And I think that's what we'll be watching for. Is this now in an uptrend, similar to COVID, similar to '08? Let's go back to '08, right? Here's '08. This was in an uptrend, and then we had the explosion higher, and then we had periods where this was in a strong uptrend, and then the Fed came in with QE and then calmed things down. Same thing here, right? In 2015, 2016 time frame, and then Fed came in with QE. So this is going to be interesting to see how this goes, and obviously will feed into the labor market, it will feed into recession probabilities, etc. But this is the first shot across the bow that this is serious. This is a credit event to some degree. And when you have credit events, it means you have defaults, it means you have layoffs, it means, and that snowballs. And we were already in a situation where the labor market was relatively weak. Okay, you can see this is in a general uptrend. This is the initial claims for unemployment insurance, and this is likely to head higher. This is the first sign from last week that you got to tick higher, but we'll see in the coming weeks what type of layoffs we get for the month of April, and that's going to be very interesting to see what employers do in this environment, in an uncertain environment of how recessions are going to go. Is he going to walk them back? Is he going to keep the 125% on? It's a 90-day pause, but what does that really mean? We're still at 10% for most countries and most everything. And so there is this tax, and 10%, while it's much smaller than what was floated out there on Liberation Day, it's still a big jump from where we were before, right? So this is a tax on consumers in an environment where they were already struggling, and you is also regressive tax. So it's going to hurt the lower income consumer more than anything, and they're also the ones most likely to lose their job. And so that's really the main issue here. And you have the recession probability. This started out. This is the end of February. Okay, so we'll see where this comes in. When's the next release will be? Uh, on May 5th. Okay, so we're still a ways away, but you can see here this was COVID. Okay, so pre-COVID, we were already in January, February of 2020 at 24% here. Right now we're at 27, and then you had the catalyst, obviously, for COVID, and then that spike higher. But then the Fed came in with liquidity and kind of calmed down the inflation fears. So we were in a recession for very briefly, and this could very well spark a brief recession. It depends how the Fed will respond, and once again, we're in a different environment now where money is fleeing the United States, and that is kind of a problem. Another area that I'll be watching is bank credit. So, how do banks, not only how companies operate in this environment, how do banks operate in the environment? How do they lend money when they don't really have a lot of clarity on uh, where the uh, tariffs will be? What impact will that have on the broader economy, layoffs, etc. So if this rolls over again, that would be a big issue. Now it's ticked higher the first 2 weeks ago, but this is a couple weeks old, and that's why I'm not showing a lot of economic data here like I usually do, because that's all backwards looking. This is we had CPI data on Friday, and inflation data, but that was all in the month of March. Anything March, February, March kind of does not matter. This is a new regime, new paradigm shift, and that is where we are at. And so, we're kind of have to look at this data as it comes in. You want the most real time data, and make sure you're more than ever focusing on that, focusing on what is coming in that is telling you what's happening now in the market, what's happening now in the economy. And, you know, s- so far, it doesn't look great. Okay. Now let's start with the dollar, right? So here's Liberation Day, okay, and you can see this is the dollar UEP, the dollar index. So this is gone down about 5%, 6% since Liberation Day. Once again, this is the opposite of what typically happens when it's a risk-off environment. It means money typically flows to U.S. assets. That's not happening anymore. Same with look at treasuries, right? You would think that the initial move was higher, okay, meaning bonds rallied, 10-year was lower, but that quickly reversed, and now we're higher, okay. And let me pull up this. go to Mortgage News Daily. I love this one. Let's look at the 30-year fixed. Look at the 30-year fixed now, right? This was back Liberation Day. We had rates at 6.75. That was the 30-year average fixed mortgage rate on Liberation Day. Where are we today? 7.07. We're over 30 basis points higher. And the Fed has done nothing. This is all market related, all related to the 10-year Treasury. So this is clearly money leaving the United States, selling dollar assets and selling the dollar, right? Because lots of times they're moving it offshore, right? A lot of times you might sell equities, you might even sell treasuries, but you're going to put that into dollars and hold those in dollars. Now it's saying, no, we're moving those out. We're moving those into other currencies, and we're moving it into the ultimate currency, which is gold. Gold continues to be strong. Now it's certainly a bit overbought here, but generally the trend is still very good. You have that pullback to the 50-day. Nothing can really keep this down, at least in the short term. Now, does that mean we can't have a broader pullback in the summer? No, but clearly this has to be part of everyone's portfolio to some degree. Silver did have a tick down, but it's starting to gain some strength. So I could see this moving higher as well. And then the miners are starting to really outperform. If you look at like GDX to GLD, this is starting to move higher. Look at GDX to the S&P, right? The miners are drastically outperforming what the S&P is doing in a big way, and I think that will likely continue. And then if you do something like an XLP to an XLY, which is the staples, right? Staples continue to be an uptrend compared to the consumer discretionary, and I think that will continue once again. Now, one issue with some of these other, let's just say, non-cyclical names is they tend to be bond proxies, and bonds are going to sell off because the rates are going up. I think they're going to have less juice, shall we say, to buffer losses. That doesn't mean you don't have exposure there, but I think going overboard is maybe something that you want to avoid. Okay, but once again, these are definitely going to hold up, right? If you look at an XLU to the SPY, right, that's still moving higher. That's still generally moving higher, even on days like the weeks like this week. This is just a minor move down, and it shows you that utilities are a better place than just broad S&P, for example. Same with if you go to the consumer staples, right? XLP to the S&P, still in an uptrend, will likely be in an uptrend. Okay. Now, energy is one of those ones. This is going to be interesting. You had this move down, but if the dollar continues to weaken, I could see this actually slingshotting higher. Right? Harder assets are going to be more in demand. Now, it's more of a mixed picture here. There's obviously OPEC news. It's kind of fully baked in. How deep is this recession? Is it a minor recession driven by attacks on consumers because of the tariffs, or is it something that once again spreads to corporate bankruptcies and some more layoffs, and then suddenly I think demand destruction becomes much broader. So we'll see. Still kind of on the fence here with what energy will likely do, and you see that with the USO did move down, but it hasn't really broken in a major way. Okay, let me go back here. Let's go to the weekly chart. There we go. Right, hasn't broken below this kind of consolidation period that it's really been in since early 2022. So, and we had a bottoming tail on the weekly. So I'm still on the fence once again with energy. What else do I want to get to? Oh, let's go to the MOVE index. I love this one, especially in times like this. This is where there are issues, and this is why I say the Treasury Fed will have to probably step in. Remember, when this gets above 150, this is the Treasury market dysfunctioning. Okay, that there are problems that the Fed is going to have to step in. And despite that bounce on, what was that, Wednesday? This closed near the highs of the week. Okay. And this shows you that money once again is flowing out of dollar assets, treasuries, and you don't want duration risk. Okay, you want to keep your bond exposure on the short end. We're looking at our holdings and trying to limit duration exposure. And so this move index is looking similar to where we were back in early 2023 when we had the Silicon Valley Bank crisis and the Fed had to step in with BTFP. And I think they're going to have to do something as well very soon. So when this is elevated, this is not good for markets. And here's the VIX. The VIX has come down, okay, but it's still at 37. So could this kind of come down, hang around the 24 in the 20 range, and then move higher and just have this being an uptrend? I think that's more likely. My base case is we get a little bounce for a couple weeks. Everyone thinks kind of things are okay, and then we roll over and probably make new lows, and then forcing the Fed to step in, forcing maybe shift in policy, and we get a bottom sometime in early summer before we get a reasonable bounce, and then we'll see what we get into year end. But that's kind of my base case here, and we could get a bounce into kind of this level is what I'm expecting. We've already tested this 5,500 on Wednesday, had a pullback. Once again, we'll likely get to move higher on Monday due to the exemptions on smartphones and chips, but that will probably not propel us very much higher. 5,650 is kind of my area where I think there's major, major resistance. Now, if we could eventually get above the 5,800, well, then this is just a blip on the radar and no big deal. This was just market freaking out and the White House coming out with crazy policy and walking it back and move on from there. That's not my base case, but you have to be open to that possibility. My base case is this is a recession. You're going to get large rallies like you did on Wednesday. You'll get another rally on Monday. And in down markets, in bear markets, in recessions, you get very strong rallies. And then you get, a lot of, down 1%, down 2%, down 0.5% type of days, kind of more consistently that take back those gains in relatively short order, and that's kind of what I'm expecting in the medium term. So that's where I'm at. Let's see, is there anything else I want to get to? We can look at the banks, and this is really the kind of the canary in the coal mine. Look at banks. Banks are struggling. Even if you look at investment banks, okay, here is IAI also struggling. That Blackstones of the world. Here's BX. Okay, the Black Rocks of the world, all below the 200-day moving average, and these are levered businesses. Anything private equity related, private debt, I think that's where there's going to be major, major problems. And the fact that these rolled over sooner, these topped in December and November, and so this was kind of a signal. Obviously, we didn't talk about it much. I didn't frankly recognize it. I didn't think that we'd truly roll over in markets until summertime. But I was wrong. We've broken. The market is in a downtrend, and you have to treat it as such until that downtrend that downtrend is broken to the upside. And we're not there yet. Until we get above this 5,800, we are not there yet. We are in a downtrend. This longer term chart is broken, right? This longer term uptrend is broken. Now we found support here, 200-day moving or 100-day moving average, but ultimately would not shock me if we get back to this low. 3,500 was the low from 2022. That's kind of my general expectation. This is big. This is not small. This is foreigners leaving the United States in a big way, and that's going to weigh on equities. It's going to weigh on risk assets until there's some sort of repair to the damage that has been done to global trust in the United States, in our policy regime, in our ability to treat allies as allies. Right now we're treating them as enemies in many ways. And so when you treat when it's just like having a friend. If you have a friend and they do something that's against your interests for the first time in your lifetime, suddenly you start to rethink that relationship, and that's what the world is kind of doing right now. Especially when we used to be the best friend. We used to be the most trusted friend. We used to be the friend that had the most fun with, and everything was great. And now that in many ways is shattered. Now, can it be repaired? Just like any friendship, probably over time it could, but in the near term, there's just too much skepticism, and this trust has been broken to a large degree, and that is going to manifest in flows. And once again, it already is manifesting in the flows in markets. And so, uh, I don't want it to be this way. I want the U.S. to succeed. I want the changes, which I'll certainly admit with President Trump and those in his coalition, that there are issues that need to be addressed. It probably takes a different tact, a different strategy in my mind. Now, I could be wrong, but I think it's a strategy that maybe uses a little bit of tariffs, but probably is more industrial policy based and worker retraining and things like that to really bring back capabilities to the United States that are in a national security interest. So maybe we get there. Maybe this policy evolves. Maybe tariffs do shrink to a level that is not a major tax on corporations and individuals, and they pivot towards industrial policy. Maybe we get there at some point. But right now, that doesn't seem to be the path forward. And so, you have to be honest with the drawbacks of policy, whether that is from an individual company level, right? Strategy, as well as at the government level. And this strategy so far, it's weakened the dollar, it's raised interest rates, it's created more uncertainty for corporations, both large and small. Many companies are pulling guidance going forward, and so in that environment, that's maximum uncertainty. Uh, and it's not just U.S. investors anymore; it's global investors, because so much money is tied up in the United States, and that is the situation we are in. So once again, you see rallies. If I pull up the Nasdaq here, there we go. Here's the Nasdaq. Here's the weekly. Do we retest this downtrend line, or sorry, uptrend line that we broke here? We could, up to 18,000 or so on the Nasdaq. I could see that certainly being the case. But unless once again we recapture, you know, about 18.5, 18.6 on the Nasdaq, this is in a downtrend, and you have to treat it as such. And so that's where we're at. I hope everyone has a wonderful weekend. I appreciate you all tuning in, liking, and subscribing to this channel. A reminder: this content of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.